Now we are going to one very important area, definite question in exam, that is foreign currency exposure hedging. Basics of hedging, have a backup before breakup. That is basically protecting your risk. In foreign exchange, what risk is there? What are the various instruments available? And to what extent risk can be managed? All those things we have to understand here. We have discussed the hedging even in index futures, portfolio hedging using index future, in derivative delta hedging. I mean, using delta, that portfolio replication approach. That was chiller. Now, this hedging is the real monster because in foreign currency hedging, we have various alternatives. In the exam, they'll ask you which alternative is suitable in a given situation. So, what do you mean by hedging? Risk reducing or avoiding risk. And what is the risk in this chapter? Of course, this is just this chapter itself risk for most of you. The exchange risk keeps fluctuating. Conversion rate, that is the risk. And what we are trying to do is, because of the exchange rate fluctuations, inflow or outflow is uncertain. For exporter, inflow; for importer, outflow is uncertain. And we are trying to stabilize that, making the cash flow certain. Sometimes absolute certainty is possible, for example, by entering into forward contract, even by doing money market hedging. And sometimes we may not be able to protect 100%, for example, if I go for futures. So making the cash flow certain to the extent possible. Okay, now coming to the types. What are the hedging mechanism possible? We have forward hedging, where we enter into forward contract, simplest of the all. We have money market hedging, using the operations in money market, which means using deposit in dollars, deposit in rupees, or borrowing in rupees, deposit in dollars, something mixture of deposits and borrowing. That's called as money market hedging. Concept of netting, setting off. If you have receivable and payable, we can do set off. We have leading and lagging. We do set off, advancing, or we extend, postponing. That's called as leading and lagging. I'll explain that. Then using foreign currency exposure hedging, I mean option hedging, future hedging, currency futures. We also have other type of problem. If you've already taken a foreign currency loan, how do you cover it? Forward cover or money market cover? Or we have a particular variety of problem called as the supplier credit versus bank credit. So many varieties of problem. Even letter of credit, one concept is there. All those things ultimately will come in this area. So many areas are there. Let's try to have an overview of each of these areas. We also have currency swap. Maybe currency swap, I will not cover it here. Maybe I'll cover it in the interest rate management chapter, because interest rate swap, that becomes currency swap. Okay. Now, let me try to cover first two things, that is forward hedging and money market hedging, called as forward cover, money market cover. Let me explain. Give me a second. Okay. Hedging for exporter, I will explain forward market also. I'll explain money market also. I'll also try to cover the basic concept of hedging once more. Imagine You are a exporter. And what does exporter do? He will sell goods to his customer and he will receive the payment. But the payment he will not receive immediately. He'll give the credit, he'll give the time to make the payment. So customer will make the payment in dollar terms to you. You are an exporter. You receive US dollar when? After 3 months. You are an Indian person. You receive USD. What do you do with that USD? You will have to sell in the market, in the currency market, so that you get the rupees. But when will you come to know that conversion rate? Only after 3 months. When you actually go to the market, go to the bank and say, give the dollar, take the rupees. And how much rupees you get depends on whatever is the spot rate on that point in time. And that rate, do we know today or will come to know only after 3 months? Definitely will come to know only after 3 months. And that is why it is uncertain in nature and it is called as a unhedged position. It is called as the unhedged situation. Unhedged. Uncertain. Risky position. Unhedged position. Where the spot rate will be known only at the time of settlement, not known earlier. This is the risk you are exposing. At how much rupees you get, we don't know. Let's say we are in December 2021. 3 months later, by March end, you receive dollars. What will be the conversion rate by March end? We don't know. Maybe corona situation would have increased or decreased. Some more third variant, fourth variant, fifth variant. What would have happened to us? We don't know. Uncertain. It might increase also. It might decrease also. In exam, they'll ask you that question also. Unhedged situation, what would be your position? Of course, that you'll come to know only on expiry. But as a post-mortem analysis, we might have to give comparison. Had you done forward hedging, what would have happened? Had you done money market hedging, what would have happened? Had you kept the position open position, unhedged position, what would have happened? Then we say, oh, this would have been the best. As a post-mortem analysis, of course, not known earlier, this will be known only on expiry date. Okay, now this is the situation we are trying to avoid to the extent possible. And that process of removing this risk, managing this risk is called as hedging. Now, you are going to worry about what rate I get, I don't know. I know I'm going to sell USD. What rate I will get, I don't know. So you agree upon a rate. That US dollar you give, but the rate at which you receive, you agree upon a rate. That is what is called as a forward rate. And what forward market you go? You're going to enter into forward sell, right? You're going to do forward sell. Why forward sell? Dollar I'm selling. So it's going to be forward sell contract. So forward sell contract is called as forward hedging. If I keep it open, that's called as unhedged position. I enter into a forward contract so that the rate at which I get my money is fixed today, predetermined today, called as forward rate. This process is called as forward hedging. In the exam, what are the other kind of question you can expect? You can expect, had you not done the hedging, how much would have been your profit or loss? Impact of hedging. By entering into hedging, let's say the rate is 72 and unhedged position, it happens to be 73. So actually you lost by hedging because you lost the 1 rupee opportunity. But if the rate was 71, actually you saved 1 rupee, you gained 1 rupee. Notional profit or loss can be asked in the exam. Okay, now here is one more method, that is money market hedging. How do we do money market hedging? Think this now. You have US dollar with you, which you receive from customer. One option, you can sell in the spot market, that is unhedged position. Second position, you can sell in the forward market, a rate committed earlier, that's called as forward hedging. What is the other way of disposing the US dollars? Remember, you receive USD from your customer, USD is on your hands. What you do with that? You deposit again. No, I want to get rid of now. I sell in the spot market, it's uncertain. I sell in the forward market, forward hedging. What else you can do now? It's a very interesting situation. You use it for repaying a US dollar loan. Means you take the loan today. Or hedging technique, what most people say, you have an asset, you have a receivable amount, right? You have an asset. For that asset, you create a liability. You have a receivable in USD, dollar asset is there, you create a dollar liability, you take a dollar loan. So you borrow USD today, you don't deposit USD. Borrowing and deposit cannot happen in the same currency. So you borrow USD, you convert in the spot market to rupees and deposit rupees. And on maturity, after 3 months, this deposit matures. Borrowing you have to repay. No need to worry about the borrowing repayment. Why? The dollar comes from the customer, give it to him. That's all. That is, borrowing will be repaid. So US dollar comes from a customer, you repay to the bank, dollar loan, dollar assets, set off. It's closed. But rupee deposit will come. That is your effective proceeds. And one point to be kept in mind, when you do borrow, don't borrow amount equal to invoice. If receivable is $1 lakh, don't borrow $1 lakh, because after 3 months the loan 1 lakh will be added with interest. So you should take a loan such a way that it will be equal to invoice amount, repayment amount along with interest. In other words, we do a present value of USD at a borrowing rate. So along with interest will exactly be equal to the invoice amount. And US dollar, you are converting your deposit rupees. So you are going to use a sell rate, dollar to rupees. Dollars is sell and rupee your deposit. So deposit rate. So ultimately whatever you get, that is the effective proceeds. Deposit mature, effective proceeds under money market hedging. You can take a quick screenshot of this maybe. You can copy it down later. Because I would like to give a overview of the hedging. Later when you do problems, you can revisit this concept, apply this concept and you can solve the problem. But at this point in time, I want to give an overview of different hedging technique available. So money market hedging for export. Okay. So in the exam, they'll ask you compare money market cover, forward cover. Forward cover, amount you get by selling using forward rate. Money market cover, here deposit maturity, that is your effective inflow under money market hedging, whichever is higher, exporter, whichever is higher, that is his cash flow for him. We have to recommend suitable strategy. Okay, now you observe here. This process of thinking to replicate in exam is very, very difficult. I have a solution for you. Don't worry. Just focus on this process. What essentially we are doing? I am doing present value, then I am doing future value. Okay. So for this spot rate, if I apply, what and all I am doing, this I am doing present value divided by 1 plus R to be specific foreign interest rate. And this I am maturing deposit, I am compounding. So I am multiplying by 1 plus R. So while discounting, I am using USD rate. I am compounding, I am using rupee rate. That means compounded by local, discounted by foreign. Have you heard of this sentence somewhere? Have you seen this formula somewhere? We take the spot rate, Numerator, I do 1 plus local rate. Denominator, I do 1 plus foreign rate. That is interest rate parity theorem, right? So there is a shortcut which we can apply for money market hedging for exporter as well as importer. I'll show you that shortcuts. Okay. So what shortcut we can do is this directly for exporter. We're trying to understand how much amount you receive. For that purpose, what you have to do? You start with the invoice amount. Easy. Spot rate. Easy. Then money interest rate parity theorem. 1 plus local rate by 1 plus foreign rate. Very easy. Now, the problem is, sir, how to decide sell, how to decide deposit, how to decide borrowing. I'll tell you the logic. You are doing for an exporter. Exporter, what is his nature of operation? Exporter sell, sir. Exporter sell rate. Now, once exporter sell, what he has? Asset or liability? Exporter is receivable. So he has the asset and deposit in numerator, opposite, denominator, borrowing. Numerator local currency, denominator foreign currency. Let me write for importer now. If it is a problem on importer, what he will do? Invoice amounts, that is same, into spot. Importer is a buyer. Spot buy rate into 1 plus local currency by 1 plus foreign currency, that is interest rate parity theorem, that is fixed. That is fixed. Then what is the nature of importer? He will have a liability. Therefore, in numerator, I will have a liability, that is a local currency liability. That is, you can say deposit, rupee liability. Denominator, opposite, deposits. Straightforward thing. Sir, do we get the answer if I write the answer in one line? My expectation is no. Sir, we are getting the answer in one line. Why they don't give marks? You get the answer in one line. But practically, do we achieve this directly by one line? One transaction? No. You have to follow a series of transactions which results in the shortcut. So you should give us a knowledge. You should express in the exam what are the series of transactions. You have to show the steps. So for step purpose, you can follow this format. First step, you do this denominator. Second step, you do spot sell. Third step, you do deposit. I'll explain this. Take a look at this. So if it is for exporter, first step, I borrow in foreign currency. Second step, I spot sell. Third step, I deposit and gets matured. In case of importer, I do present value for deposit of foreign currency. That much amount I will buy and then I have to borrow and repay. Remember like this arrow, starting down, going left side, going right side. One step, second step, third step. So this will tell us the series of transactions involved, which will give you the marks. So remember the shortcuts and the steps we are going to write. Denominator 1, go to numerator second, and right side third. 3 steps. Shortcut. Money market hedging done. A forward hedging, as simple as I can say. For importer, he will do forward buy. He needs to buy. Exporter, he will do forward sell. Simple. So any doubts in the money market hedging in the steps, shortcut steps, which is what we are going to apply while solving problem as well. But writing only this one line, you will not get marks. If the value is in very good mood, he might get, but mostly they will not be. So I recommend you can use the shortcut, remember the steps, but you have to present using steps. Steps carry marks. Okay, so this is about money market hedging and currency hedging, forward hedging. We have some more varieties. Let me cover one by one. Okay, next. Okay, next we have this concept of netting. Netting. Netting means what? Set off. If you have receivable and payable on the same day, receivable and payable on same day. So what do you do? Instead of converting it to rupees, you can directly ask them to make the payment. Direct payment from customer to supplier. What do you mean by that? You have $1 lakh receivable. You have $1 lakh payable. Then what do? You tell your customer, don't transfer it to my account, directly make the payment to my supplier. What is advantage now? In that case, you don't have to convert it to rupees, which you need a forward sell contract. Then from that you have to buy dollars. So forward buy contract. So both the rates you can save. So you don't require sell contract, you don't require buy contract, and also you can save transaction charges, because spread will be there in buy rate, sell rate, margin will be there, time gap will be there. You tell the customer, make the payment directly to the supplier. Set off, done. No need to convert to rupees. You save charges, you save spread. That is set off. But what if receivable and payable are on different dates? Receivable and payable are not on same date. Are not on same date. Then we have this two alternatives available. Either we do leading or we do lagging. Let me explain. What is this leading or lagging? Leading means what? Suppose receivable after 1 month, payable after 2 months. Time gap is there. Now, what do? Payable after 2 months, you tell the supplier, I'll pay after 1 month only. Give me some discount, cash discount I will get. You understand? You pay in advance, or if receive in advance, you tell the customer, pay me in advance, for which there will be cash discount. So leading means it will have payment in advance. Payment in advance. And then set off. So that you make the time equal, and payment advance means there will be cash discount involved. Payment in advance, making it equal, and then you do set off. That is, you ask the supplier to make them, you ask the customer to make the payment to supplier. But here there will be cash discount involved, you should be careful. Cash discount involved. Cash discount involved. And you have lagging. What is lagging? Receivable 1 month, payable 2 months. You tell the customer, don't pay me now, pay me after 1 more month. Or payable is after 1 month. Then you tell the supplier, I'll pay you 1 more month later. You are delaying the payment. Lagging means delaying the payment. And delaying the payment and then set off. Delaying the payment and then set off. This process is called as lagging. And this will not have cash discount. This will have interest components. You are paying later. Supplier will say, pay later. Why will you do charity? Say, pay me interest. Right? If you're lagging, if you're delaying, then there will be interest either with the customer or with the supplier. Then you ask them to make the payment to each other. I mean, you ask the customer to make the payment to supplier. Set off will happen. Of course, by considering all these cash flows, we have to make a decision. Overall, Which cash flow is beneficial? No formulas here. We have to do under two alternatives. For importer, whichever cash flow is cheaper, we select. For exporter, whichever cash flow is higher, we select. But the process, the concept is this under netting. So we have understood unhedged position, forward cover, importer will go for forward buy, exporter will go for forward sell. Money market hedging, shortcut also explained. Netting, which involve the concept of leading and lagging. Okay, now next, one more type of problem typically comes in examination problem, especially from Indian point of view only. That is the supplier credit versus bank credit. In the sense, you are an Indian person, working capital management problem. You are borrowing or you are purchasing goods from Japan, you are purchasing goods from Germany, but making a payment after 3 months. But instead of making payment after 3 months, if you make the payment immediately, two alternatives are there. If you make the payment after 3 months, supplier might charge you interest. He say, you are paying me after 3 months, so pay me some interest. But if you take a loan from Indian bank and pay them off immediately, you save interest there, but you will have to have interest in the local bank. It's like a local borrowing versus foreign borrowing problem. Should I take the supplier credit or should I take the bank credit? What are the cash flows involved? I quickly summarize the chart for you. Supplier credits. If you use, that means you are using his interest rate. He might charge you interest. That is like foreign interest rate. Bank credit. You're using the local bank like overdraft. So local interest rate you are paying. Conversion rate, which will you use? That's a very interesting situation. Means, are you using the spot rate or are you going to use the forward rate? Supplier credit, when are you making him the payment? Are you making him the payment immediately? No, you are going to pay after 3 months, after 4 months. So, forward rate is relevant. Now, bank credits. When are you going to make the payment to him? Immediately. That means you are making the payment today. So, the conversion rate required is spot rate. Now, why this discussion is required? That too in Indian context. In Indian context, rupee usually depreciate at least against dollar. So, spot rate will be cheaper. So, if you look at that angle, bank rate is beneficial. But you compare interest rate, local interest, foreign interest, rupee and deposit, which is cheaper normally. Deposit, dollar is the cheaper, rupee and dollar is cheaper. This interest rate is cheaper. You understand? In supply credit, we have one benefit, interest rate is cheaper. In bank credit, we have one benefit, spot rate will be cheaper. So in advance, we can't tell which is beneficial unless we calculate cash flow under both alternatives. In that context, one small point to be kept in mind, interest rate do we add first or exchange rate do we add first? If you remember the sequence, the process becomes easier. Okay. Now, in supply credits, what do? You add interest, then you make a payment, right? Because interest is added by supplier and then you make a payment. So, interest rate comes first, conversion rate comes later at the time of settlement. Whereas bank rate, you have to make the payment immediately. Today only you need to know the exchange rate. So, exchange rate comes first. That amount equivalent you are going to borrow. So, you pay interest rate. Okay, so what kind of questions will be there in exam? They will give you. Supplier is giving you 90-day time to make the payment, but he will charge you 1%. Second alternative, you can make the payment immediately by taking the local borrowing, maybe bank overdraft, but banker will charge you 4%. Which alternative is beneficial? Recommend. What you should do? Alternative 1, alternative 2. Alternative 1, borrowing in foreign currency using supplier credits. The invoice amount plus interest rate. Invoice amount plus interest rate, that is the total amount to be paid to supplier. After 3 months, let's say, take 3 months forward rate. That is the effective cash outflow under supplier credit. Alternative 2, cash flow under bank credit. Make the payment immediately. Invoice amount into spot buy rates. You have to buy the dollars to make the payment to customer. So spot buy. So low invoice amount into spot buy. This is the cash flow that will take place, and equivalent amount you borrow from bank. So spot rate into exchange rate, that is the today cash flow, that amount you borrow. Along for that, you add the interest rate charged by the bank credit, total payment after 3 months. So two alternatives you compare. Whichever cash flow is less, that one you are going to recommend from importer point of view. This problem will always be from Indian person, don't worry, and this problem will always be from importer point of view. It's a specific particular problem, importer point of view. Okay. There is one more line of question which can be asked along this line, along with this one, which is called as a LOC, letter of credit. LOC, letter of credit. What is LOC? You don't have to worry much. It is a supplier credit plus LOC. There is you are taking a loan from supplier. No, he is from another country. He says, "How can I believe your country? That you are from India." You understand? So you give him some guarantee. You give him some surety. That guarantee is called as LOC, letter of credit. So you do plus letter of credit. So if letter of credit problem is there, it is same thing, but one extra cash flow will come, letter of credit. That is a guarantee given by Indian banks to the foreign banks or to the supplier directly. It's a guarantee given, letter of credit. It's given by Indian banks, okay? Bank in India. It is a guarantee given by your bank, local bank, guarantee given by local bank. And why will they give guarantee just like that? They will charge interest. So there will be something called as a LOC commission. LOC commission. Because they'll charge. And LOC commission is a percentage on invoice amounts. It's calculated at a particular percentage, 2% on invoice amount, something like that. It's a percentage on invoice amount and payable today. But we are all calculating all the cash flows at the expiry. So what you are going to do? You are going to add interest. Interest, how do you calculate? Interest by local bank, because you have to make the payment to the banker, means today you should take the loan, not the foreign loan. You should take the local bank loan. So it's going to be interest rate, which is bank rate, bank interest. Interest by, or let's say local interest, local bank interest. So there will be 2 points to be kept in mind if LOC is there. First point, you have to calculate commission. How do you calculate commission? This commission is calculated by the invoice amount into the percentage of commission into the spot buy rates. Why spot buy rate? That is the amount of commission I should pay my bank in foreign currency. $1 lakh, 2% commission, $2,000 I have to pay them. That means that much I should buy in the market. That much rupee I have to borrow. Therefore, calculation of invoice amount, calculation of LOC commission, invoice amount into percentage, into spot buy rate. That much I borrow today, so I'll add interest, that to local interest, which will add to my cash flows. So if LOC is there, two cash flows will come. One, LOC commission. Second, interest on the time value of money that will get added to your cash outflow in supplier credit. Then you make a decision whether it is worthwhile to do supplier credit or bank credit. Okay. And one more type of problem you know already, but I'll just repeat once more. That is on local borrowing versus foreign borrowing. I'll explain, I'll do it once more. Local borrowing versus foreign borrowing. They'll tell you like this: you have a project coming up which requires $1,000 or $1 million. Two options you have. One option, borrow $1 million from a foreign bank, or equivalent amount you borrow from local bank, then convert it dollars, make use of it, or vice versa. You need 10 lakh rupees for your business, you borrow 10 lakh directly, or you borrow dollars, then convert it to 10 lakh rupees. Local borrowing versus foreign borrowing. One method is there, like the way we did in supply credit bank rate, loan amount today, interest payable after repayment time. Foreign borrowing, equivalent loan amount today, along with foreign interest, then repayable foreign borrowing into forward rate, wherever the cash outflow is high. So you can do like that. Okay, let me just show it. If it is local borrowing, then what will be the cash flow? Whatever the amount of loan taken plus interest, local interest. This is the total repayment amount. That is one method, straightforward. Second, if you do foreign borrowing, you should take the amount of loan, dollar loan, foreign currency loan. How do you calculate the foreign currency loan? Sometimes directly available, sometimes if not available, whatever the project amount in local currency divided by spot buy rate. Because you have to convert it to rupees, or you divide by the spot rate. By yourself, you decide later. You divide by the spot rate. That is the amount of dollar loan, foreign currency loan. You add a foreign currency interest, then you do repayment into forward buy rate. Why forward buy rate? Because there is the amount of foreign borrowing you have to repay. That is forward buy rate. Then you choose whichever is lower. Whichever is lower, that becomes your recommendation. This is calculation till the final amount, like the way supplied bank rate. Or you can do one more method using IRPT. Also, you can do using IRPT. Remember IRPT? We calculate interest rate differential. Interest rate differential. Then we compare with forward premium. So if interest rate differential is cheaper, you go for local borrowing. If forward premium is cheaper, then you go for foreign borrowing. This is another way of giving the recommendation. So this is the problem on particularly local borrowing versus foreign borrowing. So local borrowing means amount of loan taken plus the interest. This is the amount of repayment you are going to do. If it is foreign borrowing, then project amount 1 lakh rupees, 10 lakh rupees divided by spot rate gives me the amount of dollar to be borrowed, foreign currency loan to be borrowed, plus the interest rate in foreign currency, repayment in foreign currency multiplied by the forward borrow rate, that will give me the rupee terms, local currency terms. Or using IRPT, interest differential versus forward premium. If interest rate differential is cheaper, local borrowing, forward premium is cheaper, I'll go for foreign borrowing. That is another way of explaining or giving the recommendation. Okay, very good. So money market hedging, forward hedging, leading, lagging, netting off, and then the supply credit versus bank rate problem, local borrowing, foreign borrowing, that kind of problems. Okay, then we have a particular variety on forward market disposal that I will discuss it later. Now I'll come to uh, two more important aspects. Again, problem will come later, but two more important aspects where many people again have an issue, that is hedging using foreign currency future, hedging using foreign currency options. So let me explain that. So I'm just trying to give an overview so that you get an idea first. Then when you do problem, you get a clarity as what to be applied. Currency option. Currency option. First of all, I assume you know what you mean by options. Options mean it's a contract entered today to be settled at a future date at the option of the holder. Holder will decide. Call option, right to buy the underlying asset. Put option, right to sell the underlying asset. Holder pays the premium. Writer receives the premium. I'm not repeating all those things. I hope you know it. It's an option contract where the underlying asset is a currency. We have discussed in derivative chapter, underlying asset is shares or even index or commodities. Underlying asset is a currency. So you will have option premium payable by the holder to the writer. Holder gets the right. What right? Right to buy? Not today. On expiry dates. And what right? It might be right to buy or it might be right to sell. Right to buy, that's called as call option. And if you have right to sell, that's called as put option. At what price you get the right? Strike price decided today. On which date? Expiry dates. Okay, these are the special regular feature. What is intrinsic value? Premium. Intrinsic value minus premium is called as payoff. What is break-even point? What are the different strategies? I hope you can recollect all those things. But apart from all these regular features, in currency option, there is one special feature, very interesting one. See, in underlying asset where it is share, you have right to buy the shares. It's called as call option. Similarly, if I have USD, right to buy the USD is call option, right to buy. But if I'm buying USD, I have to pay rupees. So a call option on foreign currency is an implicit put option on local currency. Similarly, a put option on foreign currency is an implicit call option on local currency. So this is where people will have a confusion in the exam. For hedging purpose, should I go for call option or should I go for put option? If I have to give a shortcut, if it is direct quote, 1 unit of foreign currency is equal to units of foreign currency. If it's a direct quote, you go for call option buy, put option sell. But if it's indirect quote, you should do reverse. That's a shortcut, still may be confusing. So what I have done is I have designed a particular process. I'll share that process with you. Let me explain the charts. Then if you have any doubts, we can address that. Okay, let me explain. Okay, take a look at this. Option hedging, three-step process. Three-step process. Logically only have designed. It should not be confusing. First focus, then you can take it down or you can take a screenshot. First step, identify the type of option. That is where many people have confusion. For hedging purpose, should I go for uh, call option or put option? Follow the steps, you'll get the answer. Quotation, you will have 1 unit equal to so much, $1 equal to 50 rupees. Strike price, no, $1 equal to 50 rupees or one pound equals to $1.5. Quotation will be there. The left hand side, what is there? No, that is the underlying asset. $1 equal to 50 rupees. Dollar is underlying asset. 1 pound equals to $1.7. Pound is underlying asset. Left hand side is underlying asset. One more way, you'll have lot size. Lot size, the multiple of that only you have to buy. Reliance share 250 lot size. Infosys 600 lot size. Index Nifty 50 lot size. Bank Nifty 25 lot size. That lot size. So whichever currency mentioned in lot size, that is the underlying asset. You can also remember like that. The currency of lot size. For example, one lot, 1,000 pounds. Pound is underlying asset. One lot, 1 lakh rupees. Rupees underlying asset. The currency of lot size. Currency of lot size is also, you can say, underlying asset. Then you see, with respect to underlying asset, am I purchasing or am I selling? If underlying asset is purchased, you go for call option. If underlying asset is to be sold, you go for put option. Example, take a look at this. Lot size. Okay, $1,000. And we are talking about an importer in India who wants to import in India. He will buy dollars, right? He has to make the payment to supplier. He needs dollar. So in the option contract, you need to buy dollars. Get the get the basic process. You get the money from the option contract. You make the payment to the supplier. So to make the payment to supplier, I need dollars. So dollar to be purchased. Sir, what is underlying asset? Dollar. What I'm doing with respect to dollar? I'm buying dollar. I'm buying dollar means call option. Fine. One more example. Lot size is $1,000. We are talking about an importer in Europe. Okay, importer in Europe. European is borrowing and is purchasing goods from US. So European needs dollars. He is going to buy dollars in options. So underlying asset is dollar. You are buying dollar. So what you are going for? Call option. Okay. Now please let me see if you are able to do it. Lot size is 10 lakh rupees. Lot size 10 lakh rupees. You are talking about an exporter in India. Can you tell me call option is appropriate or put option is appropriate? Of course, exporter in India to, let's say, USA. Do you think call option or put option? Normally, what do you think? Straight away, exporter, sell, put option. But I told you, don't do that shortcut. It will not work. Look at the process. What is the underlying asset here? Lot says 10 lakh rupees. So, what is underlying asset? Rupees underlying assets. Whichever currency lot size mentioned, that is your underlying asset. Lot size 1 lakh pounds, pound is underlying asset. Lot size 1000 euro, euro underlying asset. Lot says 10 lakh rupee, rupees underlying asset. This is a particular area where people are confused. Where lot size in rupee, basically indirect quote. Okay, now rupees underlying asset. Hope that is clear. Okay, now as an exporter in India, what you have to make? Dollar you'll receive from the customer and you sell in the market. Dollar you are selling. But is the underlying asset dollar? No. Dollar you're selling means rupee what you're doing. Rupee I'm receiving rupee. I'm getting rupee. I am purchasing rupees. If the underlying asset was dollar, I would have gone for put option. But the underlying asset is rupees. Rupee I'm getting. Rupee point of view I should think. So it is call option. One more example I'll give. See if you're able to do. Lot size, in this case I will give a different thing. Let's say 1000 pounds. And he is an importer in UK. Okay, so importing goods from USA. Importer in UK. Importing from USA. Now, what is the underlying asset in this case? Can you tell me? Basic thing. Underlying asset is pounds. That is clear. Now second point. Importer in UK means he's buying the goods from USA. So how much payment he has to make, what currency he has to make is dollars. But he needs dollar, right? Hope you're able to get. As an importer in UK, I have to make my supplier payment in dollars. I need to buy dollars. Oh, very good, sir. Importer buy dollars. Correct. Importer will buy dollars. But what is the underlying asset? Pounds. So it is not buying dollars. You have to sell pounds. Both are same. But dollar is not the underlying asset. Underlying asset is the pounds. So selling pounds means it becomes put option. I hope this is clear to you. I'll give once more. Let me see if you are able to do. Lot size, let's say 1,000 euro. You are talking about an importer in Europe or Germany from UK. Now, what option do you think is suitable? Call option or put option? First step, think about the underlying asset. Second step, thinking from that underlying asset, am I buying or selling? The same explanation I'm telling will also be applicable for uh, futures also. Importer in Europe. Think slowly, it's okay. Importer in Europe from UK. So, what is his obligation? Can you tell me? What is his obligation? Which currency he needs to purchase to be able to make a payment to a supplier? Supplier is in UK. He is in UK, not USA. In UK, he needs to purchase pounds. I hope that is clear. He needs to purchase pounds. Okay, but look at the underlying asset. Is the underlying asset pounds? Euro. So you should not tell buy pounds. You will tell sell euros. Both are same only. So selling euro means we go for a put option. If the lot size was not 1,000 euro, if the lot size was 1,000 pounds, now pounds only underlying asset, pounds I'm buying, I would have gone for call option. It's as straight as that. In every transaction, I buy something, I sell something. You do one thing. More than lot size, first you think what transactions you're doing. Buy one currency, sell one currency. That will happen in every transaction. And then see the underlying asset. With respect to underlying asset, what I'm doing, buying or selling, accordingly you do that. Hope you're able to do that. So first step is identification option. The same thing is applicable for futures also. I'll show you the process, you understand. Okay, here comes small challenge because of lot size again. Number of contracts. If underlying asset and invoice are same, example I gave you, underlying asset is pounds, invoice amount is also pounds. If both are same, lot size calculated by invoice amount by lot size. Invoice amount 10 lakh, lot size 1 lakh, 10 lakh by 1 lakh, 10 contracts. But if invoice amount is in the pounds, but underlying asset is in dollars, there is a mismatch. When, especially in this case, no, when you do opposite, you feel like call, but you select put. You feel like put, you select call. In that case, it will happen. Where if the underlying asset invoice amounts are different, then invoice amount divided by strike price, invoice amount in dollars divided by strike price in pounds, that will give you pounds. And when you get the pounds, lot size in pounds, you'll be able to get the number of contracts. So if invoice amount and underlying assets are different, then you should convert the invoice amount. How do you convert? By dividing strike price. And on you'll have cash flows calculations. What are the cash flows calculation? On expiry, you will compute the cash flow. How cash flow? A number of contracts into lot size into strike price. Number of contracts, 10 contracts. Each contract 1,000 units into 1,000 multiplied by strike price. You will never divide by strike price. Always multiplied by strike price. But you know, if call option or put option will be exercised only when it's beneficial to you. If it is not beneficial, you don't do strike price, you do market price. Correct? If the option is not exercised, then more don't multiply it by strike price, you multiply it by market price. But usually, if standing today, I don't know what will happen, so I'll assume that strike price is exercised. But if they give you information, what would happen on expiry date, then I'll select the market price. One more thing they can do it. You know what? One more thing what they do, they will give you probability on expiry. It can be 1.8 per pounds or 1.7 per pounds, 1.9 per pounds. They will give you various possibilities, probabilities. Then under each probability, we'll calculate the cash flow multiplied by the probability, expected value approach. That's what we do on expiry if probability is given. Anyway, when you look at the problem, you'll appreciate better. If any fractional thing can come, yes, because the number of contracts may be rounded off. If fractional thing comes, then we enter into a forward rate for that fraction. On inception, at the beginning, you have to pay premium. So premium calculation will be number of contracts into lot size, same formula. Number of contracts into lot size, same formula. You don't multiply it by strike price, you multiply it by premium. One extra situation will happen here, one super concept which will happen, that is in this case, when the underlying asset and invoice are different. No, in that case, premium you will get in foreign currency. You are an Indian, underlying asset is rupees, premium you will get in dollars. So when premium is in dollars, when premium is in foreign currency, you will have one extra step converting it into local currency, spot buy. And interest on premium, some problem institute considers it, some problem institute don't consider it because premium is payable today, but the strike price payable expiry. There is time value of money. So on the amount of premium, sometime interest is considered and sometime interest not considered. So in the exam, you can do both, give a note. But one point remember, all this hedging is only from holder point of view, not from writer. We are not thinking at all from writer. As an option holder only we are deciding, not as option writer. And one more small point, strike price and premium are like conversion rate. What's the nature of conversion rate? When I multiply by the conversion rate, another currency is obtained. For example, let me take this one. Okay, number of contracts, 10 contracts. Lot size is, let's say, 1000 pounds. And premium is, let's say, 1 pound equals to $0.25. So multiplied by 0.25. What will be the answer here? Will the answer be dollar or will answer be pounds? Answer will not be pounds because this is the pounds. On that I am applying the premium rate. Premium rate are like conversion rate. So when I apply conversion rate, I will get the answer in dollars, like $250. Now $250, should I keep it in dollar terms or should I convert back to pounds? If the problem is from US person point of view, $250, keep it that as the cash flow. But if the problem is from European or if the problem is from UK person point of view, British point of view, then dollar is a foreign currency. You can't stop it at foreign currency. You convert it to local currency using spot buy rate. This particular situation I'm explaining, hope you're able to follow it. I'll do one more. Suppose it's given 1 euro is $1.8 and lot size, then contracts into, let's say, lot size is 1000 euro multiplied by 1.8, you get 180 or 1800. Okay, now this one, is it in euro, is it in dollars? Can you think of that? What currency it will be there? It will be dollar. Hope that is clear, because when we have euro, you apply the conversion rate, be strike price or premium, that will be in the other currency. That other currency here is dollars. Now, should I keep the premium amount in dollar or should I convert it to pounds? That answer directly I can't tell. I should tell from the point of view of which country he is from, which country we are thinking the problem from. If the person is US person, dollar is his currency, stop at that point. That is his cash flow today. At the beginning, the premium outflow. But what will happen on the what will happen if the person is from UK or from European? Then it's a foreign currency. This should be converted into euro by using the spot buy rate. Okay, and if it is an importer problem, then expiry also outflow, premium is also outflow. You are a holder, you pay premium. Call or put does not matter. You are a holder, you pay both. So you add both. Interest also you can add. If you're importer, if you're exporter, on expiry you'll receive money. Exporter will receive local currency. Exporter will receive money, but premium you pay, interest on your premium you pay. So for exporter, you have to calculate the net amount. So you can copy it down quickly, or you can take a screenshot and copy it later. This is regarding the call option. Call and put currency option hedging. Similarly, I'm going to do for the future as well. Okay. Okay. Now currency futures. Again, first let me quick give a recap of the futures, not in detail. Quick a recap. It's a future contract. Underlying asset is a foreign currency, local currency, foreign currency. What are the features of contract? Forward contract and future contract. Both are contract entered today, settlement at a later date at a fixed price. But what is the difference between future and forward? In the future, it's an instrument traded in the stock market. It has some standard features, not there in forwards, because that is over the counter product. What are the standard feature? Lot size. Margin money, like a deposit, you pay now, you'll get back later. Expiry date, standard expiry date, month end, and square off, net settlement basis. And we have mark to market settlement. You don't wait till the expiry. Amount will be created or debit from your account as a margin adjustment on a daily basis. So if it is future buy, you pay initial margin. You will have some lot size. You enter into some number of contracts. On exit, you square off by doing future sell. And profit is difference between futures and future buy. Of course, multiplied by a number of contracts into lot size. And if you have margin money, if interested information is there, that is an opportunity cost that also will be subtracted. If you do future sell, you pay initial margin, lot size, number of contracts. On exit, you do future buy, short position, you remember, and square off. Profit will be future sell minus future buy minus interest on margin money. What is a special feature in currency future? If you are buying underlying asset, it means implied selling another currency. So if you are buying foreign currency, implied selling local currency, implied selling foreign currency, and buying local currency. Just like option, a call option is implied put option, and put is implied call option. Same thing applicable for currency futures. Okay, so how do we identify in currency future? What are the steps? Let's take a look at the steps. Focus on this one. This is important. What we had in option, replicate the process. Replicate the process. How? First step, identifying type of future. Same thing, quotation, one unit equal to so many units. Left hand side is the underlying asset. Or if they mention lot size, the lot size in the underlying asset. If you are buying underlying asset, think from underlying asset point of view. Same process. I'm not repeating examples. Same process. What I told in options will repeat. If I'm buying underlying asset, what I did in option, if I'm buying underlying asset, will do call option. Here, I will do future buy. If underlying asset is sold, there I do put option. Here, future sell. Simple. Then, second step, at inception, there we compute a number of contracts, right? Same thing, number of contracts. Two situation possible. If the invoice amount is same, if the invoice amount is not same. If the invoice amount is same, invoice amount by lot size. If the invoice amount is different from lot size, currencies are different, underlying asset is different, invoice amount is different, no problem. Invoice amount divided by invoice amount divided by there what I did, I divided by strike price. Here I divided by future price, the future rate divided by lot size. When will I do this process? When invoice amount is in dollars, lot size in rupees, two different currencies. So to convert the invoice amount in dollar into rupees, what do I do? I divide by future price so that that will be in dollar, lot size in dollars, you can get the number of contracts. And initial margin, how many ever contracts you have into the margin per contract. But let me tell you, initial margin is not your cost, it's a deposit. You make a deposit, it will come back to you later. But what is the cost? The opportunity cost, the cost of borrowing, interest on initial margin. That will be your expense. I'll show you how. Cash flow at expiry. Three types. Remember in future, easy to remember. What do you do in future? Arbitrage, I told you. SFM. In spot market, what do you do? In future market, what do you do? In money market, what do you do? Net position. In spot market, what do you do? You go to spot market and sell. Invoice amount into spot rate. Spot sell if it is for exporter. Spot buy for importer. In forward market, in future market, you do square off. If you have done future buy earlier, now you do future sell. If you future sell earlier, now you do future buy. You do square off. Profit or loss will come. How do you get profit or loss? Future sell minus future buy. That's your profit into lot size into number of contracts. One extra step may come when, if this is a foreign currency, sir, when it will happen? If the lot size is, let's say, 10 lakh rupees, lot size rupees, and you multiply it by this future by future sell, you treat like an exchange rate. You treat like an exchange rate, conversion rate. So when lot size in rupees multiplied by the exchange rate, you get the answer in dollars. Dollars foreign currency. So then you will get one extra step, that is you will have to convert it to spot rate. If it is a profit, spot sell rate. If it is a loss, you have to compensate spot buy rate. So this situation will arise in this case. Whenever you apply this, no, invoice and lot size are different. In that case, this situation will arise. And in money market, interest on money, margin money, you are going to make a payment. So then you compute the net cash amount. If it is for exporter, in spot market, you receive. In future square off, you may receive, you may pay. Profit means you receive, loss means you pay. Money market, you always pay. If it's importer, spot market, you make a payment, outflow for importer. In square off, maybe inflow, maybe outflow. If it's a profit inflow, loss means outflow. In money market, will always be outflow. So this is the currency future position. You can take down or you can take a screenshot and copy down later. If you have any doubts, you can get clarified. And one more point I forgot to tell. How do we know this spot rate on expiry? How do we know in advance? In options, you know strike price. In options, in futures, how do we know? What will happen in expiry? I enter into future buy, but at what rate I square off? That I don't know. This future problem is a post-mortem problem. What is post-mortem problem? Event have occurred. You have taken the future position already, and what will be the net effect. So it's a post-mortem commentary. By taking future, after the event have taken place, we are telling, oh, this is what happened. Had I not done, it would have happened like this. They'll tell you, compare currency future hedging versus unhedged position. Now, if it is unhedged position, only this you would have got it, right? Invoice into spot rate. This would have been unhedged position. Unhedged position. You would have got 10 lakh. By doing the whole process, you got 9 lakh 90,000. You tell, not hedging would have been beneficial. You are not telling in advance. You are not giving recommendation. You are analyzing. You are giving comment post-mortem. Unhedged position would have given you 10 lakh. Future, this transaction together, all the three put together, gave you 9 lakh 90,000. The unhedged position would have been beneficial. Or if unhedged position is only 8 lakh, then you tell, oh, future position became beneficial. It's a post-mortem commentary. This will not be known in advance. This will not be not known in advance. Not known in advance. But let me tell you, almost 2-3 attempts once a problem is asked on this area, and that too specifically where lot size is rupees. You go and check the previous question paper, you will see almost 2-3 attempts once for standard 8 marks question. Indian exporter, lot size is rupees, where exporter normally you think sell, but this underlying asset is rupees, you do future buy first. A repeated problem on this area. You can check the previous year question papers. Anyway, you can take the picture of this, or if you have any doubts, you can get clarified. Okay, so this is with respect to the hedging techniques. We started from forward cover, money market cover, netting, leading, lagging, interest, the supplier versus supplier versus bank rate, local borrowing versus foreign borrowing, letter of credit problems. Then we have currency option, currency futures. One more is there, that is the interest rate swap. That I'm not discussing now. Interest rate swap means exchanging. Sorry, currency swap. You have taken a loan and you swap it with another loan. That portion we'll discuss it in the interest rate management. First, I'll discuss interest rate swap, then I'll do currency swap. That is also one of the areas for hedging purpose, where the cash flow is certain or to the extent is certain by doing these transactions. Okay, so hope you are clear. That is giving you an overview of hedging, a very essential, almost in every exam, one question is focused on this area. Foreign currency exposure hedging.